Let's talk about the two basic ways that you can structure your reverse mortgage. The first is what we call the traditional fixed rate option, and this is just what it sounds like. Your interest rate is fixed for the life of the loan. The idea is that you're borrowing money from the bank to buy or refinance a home, and you never have to think about it again. It's kind of a set it and forget it model, where you don't have a monthly mortgage payment and your interest rate is fixed for life. The downside to this option is you don't get any future draws. Now that leads me to the second option, which is what we call the growth line of credit. And interestingly enough, the majority of people use this option because it has a lot more features and flexibility. And so, just like the fixed rate option, the line of credit is just what it sounds like. It's a line of credit. It gives you access to large amounts of money that you can take when you need it. Now the great thing is you're only charged interest once you actually borrow the money. Likewise, another benefit is this money is always non-taxable. And so whether you take a few $100s or a few $1,000s or many $1,000s, the government's not going to tax you on the money you draw from your line of credit. Now, one of the best features of this growth line of credit is that the equity you have not used is going to grow at a rate that's equal to your interest rate plus your mortgage insurance rate. And so let's go back to our example of Bob to kind of illustrate how this looks. And so remember, Bob has a $400,000 home. Let's imagine that Bob's home is paid off and he owns it free and clear. At Bob's age, we're going to take 50% of his equity and we're going to leave it alone, put it into his equity reserve. The other 50%, or the other $200,000, is what Bob can use as he wishes. Now, let's imagine Bob doesn't need this money today. He's planning for the future, and so this $200,000 is going to sit there for the first year. So if Bob does not use his line of credit, he's going to grow from $200,000 to $210,000 after the first year, then up to $221,000 after the second year. If Bob goes 5 years without using any of that money, he will now have over $255,000 available for him to draw at any time. Where else can you get a product like this, where you have the backing of the government? You're protected against market downturns. You have the ability to draw large amounts of funds easily and not be taxed for them. That's why we see so many people using the growth line of credit as the option that they choose when they do a reverse mortgage.